Howdy, everybody. Welcome to Liberty Call. Today is Thursday, February 23rd, 2023. Hope everyone's having a fantastical day out there. As you can see, I trimmed up the beard of knowledge, so it's not looking quite so ragged like it did in the last couple of days. So apologize for looking like a hobo hermit. Got my Astros stuff on. It's baseball season almost. Spring training's underway. So for all my seam heads out there, I hope you're getting excited since, all we have right now is college basketball, and there's just not enough games on for me. But the Cougs kicked some butt last night. I hope I don't jinx them since it's their third time as number one in the country. But they put a whooping on Tulane last night. So that was an exciting game. And I think they play again on Saturday on ESPN2, I think. But anyways, all right. Well, if it's your first time here, please give me some thumbs up, likes, shares, subscribes, all that great stuff, follows. I don't care. Just, subscribe so you can get a notification every time I go online, usually between 2 and 2:20-ish after the market closes here Mountain Time. So if you could, please do that or share with a friend. I'm sure they would greatly appreciate some of my genius knowledge that I share with everybody on a daily basis. So, all right, I guess it was a good day in the markets. Things were, most of the morning and early afternoon were in the red, but the market, it went like this, up, or let me go the other way. It went up and then down below the midpoint and then down and came back up at the end of the day. So that's kind of how the charts looked. So let's go ahead and jump in and take a peek and see how the Dow Jones or the indexes did. Dow Jones was up 0.33%, closed at 33,153. S&P 500 up 0.54, closed at 4012. NASDAQ up 0.72, closed at 11,590. The VIX fell 5.25% today. It's currently at 2112. Canada was flat at down 0.03. Brazil up 0.5%. Mexico down 0.14. Jumping across the Atlantic, Germany was up 0.49, UK down 0.29, France up 0.25%, Netherlands down 0.12, Spain up 0.64, Italy up 0.65. Let's see here, Switzerland down 0.46, and Portugal up 0.87. The Russian exchanges were barely both up. The MOEX up 0.01, RTSI up 0.05. And the overnights in Asia were all red, almost all. In Japan, the Nikkei was down 0.34, Australia down 0.4, the Chinese markets, the Shanghai down 0.11, the SESE component down 0.13, China A50 down 0.1, same with DJ Shanghai, Hang Seng down 0.35, and the Taiwan weighted, the lone bright spot, up 1.28% for the day. So again, kind of a weird back and forth day. It's whether or not, I can't speak with any authority on why the market is so backwards and, jumping back and forth. But I think it's probably a lot of the quants out there. Or people are just, because the market was so down so much yesterday, they're just figuring, hey, we got some easy gains just by buying in today and holding for a couple of days. Hope it goes up. And if not, that is what it is. All right, well, let's go ahead and jump into today's market recap. S&P 500 advances in choppy trade as Nvidia rally boosts bolsters tech. Let's go ahead and bring up my notes. The S&P 500, on Thursday, the S&P 500 rose, but trading remained choppy as investors weighed fears about the Federal Reserve rate hikes and Nvidia-led jump in tech. Nvidia Corporation delivered upbeat guidance following quarterly results that beat on both the top and bottom line, sending its shares more than 14% higher. The acceleration in artificial intelligence adoption will spur a demand for Nvidia's chips, and Goldman Sachs upgraded its rating on the stock to buy from neutral. Alibaba reported a fiscal third quarter beat on earnings and revenue, but gross merchandise volume and key performance metrics measuring the volume of sales fell to mid-single digits year over year in its core China market. Moderna reported fourth quarter results that missed on the bottom line as rising costs and lower demand for its COVID-19 vaccine weigh on performance. Gee, I'm shocked. If it actually did what it said, maybe their numbers would look better. eBay was also under pressure, falling 8% after its fourth quarter results, and annual guidance fell short of Wall Street estimates. The choppy day of trading comes as sentiment on the broader market remained fragile amid fears of a more hawkish Federal Reserve. Wells Fargo said the recent rally in stocks was largely based on hopes that the terminal rate would remain just below 5% and rate cuts would occur at some point in the second half of this year. end quote. Yeah, that's not happening. On the economic front, data showed fewer than expected initial jobless claims continued to flag the threat of an acceleration in wages that would likely keep inflation stickier for longer. Communication services were a drag on the market, paced by a decline in Alphabet and Netflix. Netflix fell more than 3% after the streaming giant cut subscription prices in over 30 countries as competition continues to heat up. Investors are weighing the impact of rising inflation, interest rates, and potential tax hikes on the stock market. Tech stocks in particular have been volatile as they are seen as more sensitive to rising rates. Nvidia's upbeat guidance and earnings beat, however, has helped to boost sentiment towards the sector, leading to a rally in chipmaker stocks. Meanwhile, Alibaba's results were highlighted by the challenges facing Chinese e-commerce companies as they navigate the regulatory crackdown in China. The company's gross merchandise volume, we already covered that part. Overall, investors are cautiously optimistic about the outlook for the stock market, but the uncertain macroeconomic environment coupled with regulatory risks is likely to result in continued volatility near term. All right, so let's next up, inflation. Hey, that's a topic we never talk about. All right, stubborn food inflation leaves U.S. shoppers with slim appetite for other goods. As Americans face the highest inflation in a generation, they are cutting back on purchases of other goods such as toys, clothing, and housewares, which presents a challenging trend for retailers. Higher prices on food have led to soft sales on electronics, toys, home, and apparel with in the most recent quarter at in the most recent quarter at Walmart, according to the company's CEO, Doug McMillon. He added that Americans are still spending, but are more, quote, choiceful, discerning, and thoughtful, end quote, about what they buy. Food cost increases have outstripped broader inflation for nearly a year, with the average cost for food consumed at home climbing 11.3% in January from a year earlier. Coresight Research predicts annual grocery retail sales will grow by around $500 billion between 2022 and 2030. Sharp sales declines in categories other than food are forcing retailers like Target to slash prices on everything from toys to electronics. While groceries comprise 56% of Walmart sales, they make up about 20% of sales at Target, which depends more on home furnishings, apparel, and beauty. Sales for last fiscal year at Target, which reports on February 28th, are expected to rise 2.7% according to estimates, which are below the 6.7% rise that Walmart reported. Home goods retailers are under pressure with the sale of home goods and home improvement merchandise, including gardening products in 2022, making up just 11% of total retail sales, down from 15% in 2017, according to Coresight, which pulls data from the U.S. Census Bureau. At Home Depot, shoppers spend less on goods such as soft flooring and roofing in most recent quarter. At the off-price clothing and homeware retailer TJ Maxx, sales at its home goods unit slid 11% in 2022. Lowe's company, which reports on March 1st, could feel a bigger pinch than larger rival Home Depot, as Lowe's tends to draw more do-it-yourself shoppers than inflation-resistant professional builders and contractors. In clothing sales, Wall Street will learn more about the inflation's impact in March when specialty retailers such as Kohl's, Nordstrom, and Victoria's Secret report quarterly earnings. Quote, the macro outlook is on rocky ground, and I think some of the data suggests that we may not have seen the last of this, with recession looming on the horizon, end quote, said Eric McHugh, portfolio manager at Summit Global Investments. All right. So it looks like people are spending the food money, or what they would spend on, home repairs and clothes and all the other incidental things in your life. And more of it's going towards just, keeping yourself fed. So not a good thing. Next up, U.S. labor market resilient, inflation hotter in the fourth quarter. Alrighty. The number of Americans filing new claims for unemployment benefits unexpectedly fell last week, indicating that the continued tightness in the labor market and rising fears that the Federal Reserve may raise interest rates higher than anticipated. Economists had predicted that 200,000 people would file unemployment claims, but instead the figure fell by 3,000 to 192,000 for the week ending February 18th. The claims data for the week cover the time in which the government surveyed business establishments for non-farm payrolls component of the February's employment report. Continuing claims, which are a proxy for hiring, dropped 37,000 to 1.654 million during the week ending February 11th. The claims report also showed that though they remain above pre-pandemic levels, Goldman Sachs predicts that the jobless rate will rise to 3.6% by the end of the year and stay there until 2024. I think it'll probably go above 5%. That's just my personal guess, simply because as these companies start to have more red on their balance sheets, they're going to be like, all right, we need to cut overhead. All right, let's cut 10, 20%. I think, by the time the market is bottoming out, I know I've said this probably a million times already, probably that'll be the time that the employment situation will be at its worst. And then the market will be on the rise, and it'll take probably 6 months to a year for the employment situation to stabilize again. So, all right. One last article here comes from our friends over at Zero Hedge. It's titled, "The U.S. Housing Recession is the Canary in the Coal Mine." All right. Get my notes here. U.S. residential fixed investment or home building has declined 20% in the past year, marking a slump comparable with the major housing recessions, according to a report by Albert Edwards, a strategist at Societe Generale. Housing recessions are seen as a warning signals for economic recessions. Higher interest rates make it more expensive to service existing debt and take on new debt, thereby suffocating the most indebted parts of the economy, including home builders, and housing investment before impacting the broader economy. If housing investment declines by 1 percentage point as a share of the economy, this constitutes a housing recession. Such recessions have been followed by economic recessions in all but 2 cases since 1948. The current U.S. housing recession, which has been triggered by the first rate hike 11 months ago, could, if historic patterns are followed, be the canary in the coal mine for a recession starting in 23. The direct impact of a housing recession on the economy comes from changes in housing investment as a share of the economy. The direct drag on the economy created by a 4 to 2% decline in housing investment is equivalent to a drag caused by an 8 to 6% decline, which occurred in the 1950s and 60s. The structural trend of U.S. residential fixed investment has followed the number of households for the past 65 years. The report suggests that given that household investment has already fallen below its structural trend, a further 10 to 15% contraction is likely. This will impact the performance of home builders, especially their performance relative to less cyclical stocks such as consumer staples. The recent outperformance of U.S. home builders is therefore seen as a premature and vulnerable to a setback. The report concludes that while it is premature to say that history will repeat itself, the severe housing recession in the U.S. confirms that higher interest rates are having the expected effect. Higher rates make it more difficult for the economy's most indebted parts, such as, we already covered that, homeowners, home builders, and such. All righty. Well, that was everything I had to cover today. So, again, just more evidence that with everything that's going on in the world, things just don't look very good in the short term. But I'm an optimist. I think, long term, I think things are going to be very good. If we could, shed the shackles of our, government overlords and get rid of the federal government, life would be great. I think that would be fantastic. I know there's a lot of people out there who are like, oh my God, how can we live without a federal government? Well, you got a county, you got a state. You got city governments. How many more, agencies do you need over you to tell you what to do? I personally don't need anyone to tell me what to do. Don't steal, don't hurt people, don't take things that aren't yours. Be polite to others when they're polite to you. It's the golden rule, people. Come on. All right. Well, that was everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. Hope everyone has a fantastical evening, and I'll talk to you next time. Adios.